Okay, let's get started. We're very happy to have Debbie Lucas, who's going to talk about credit risk transfer and the pricing of mortgage default risk. You have 30 minutes, Debbie.
Thank you. Thanks to the organizers for including our paper, and apologies to those of you who thought you were hearing about the environment. I think the organizers were being kind to me, and even though this is really about credit risk, they didn't want me to have to present at 3 in the morning, so I think it got maybe swapped with another paper. So I hope you anyway find it interesting. So this is joint work with Ed Golding. Okay, so since the bailout of Fannie Mae and Freddie Mac, the US government has had the vast majority of credit risk associated with mortgages. It's held most of that risk. And part of the changes that occurred along with the bailout was for the regulator to tell Fannie Mae and Freddie Mac that they needed to find some mechanism by which to transfer some of that credit risk back to the private sector. And so they've created these securities called credit risk transfer securities, and this paper is about understanding those securities. The GSEs also use various kinds of insurance, but these securities are the main way that they try to meet that mandate of taking some of the credit risk that they're holding it and sell it back to the private sector or buy insurance from the private sector. So the point of this analysis is to ask whether those CRT securities are an effective and efficient way of transferring that credit risk, and whether they promote price discovery. As I'm about to explain, there's not a lot of a private market in conforming mortgage residential risk, so these are potentially a source of information that wouldn't otherwise be in the market. So just to summarize our findings up front, we're not too optimistic about these securities from the perspective of the goals of mandating them. They're pretty opaque, as you'll see, and it doesn't look like they're really providing price signals that would be very useful to the market, and it doesn't look like the price signals they are providing are being used by Fannie and Freddie to do their guarantee pricing. And furthermore, when we look at kind of the rates of return on these securities and compare them to similarly risky securities, they also seem to be very nice for investors, which means they're not a great deal for Fannie and Freddie or for the taxpayers that are ultimately paying those costs. So I always have to mention that this is really part of a broader research agenda that's trying to look at the costs and risks of government investments and financing decisions. And this really relates to a branch of it where, usually when we see a security that's been created by a private firm, we assume that either it was well designed or it would eventually go away because the firm would find a cheaper way of doing whatever they were trying to accomplish. Whereas when you take these government created securities or credit programs, there's more of a question because there really isn't kind of a market that's going to stop the government from perhaps creating something that's quite illiquid, has a higher rate of return to the investors than they might need to pay in order to accomplish their objectives. So just going to preface it by saying that what we find here is actually very similar to what I found in earlier research on reverse mortgages and on small business administration loans, and also on student loans when they were guaranteed rather than made directly by the government. Anyway, so just to start with a big picture, as I mentioned before, the potential benefits of credit risk transfer in the case of the GSEs, I think actually the number one economic reason that they could be useful is information revelation, because there aren't market price signals right now about the price of that default risk, simply because the market is the GSEs and FHA. So that information isn't otherwise available as long as the GSEs are in conservatorship, which could be indefinitely. So, the purported idea is that it might be a good idea to transfer risk from taxpayers to the private sector. I have it under the list of potential benefits, and that was certainly the purpose. It's hard to understand economically why you would think that would be a benefit under the current circumstances of the GSEs. So certainly, it's not going to add value to the GSEs. They have to pay the private market for that risk transfer. So at best, they're going to be paying private investors a fair price, 0 NPV, to take that risk. And then just in general, there's a question of, well, do you want the public sector or the private sector to bear risk? And in this case, particularly tail risk, because a lot of credit risk does have the nature of being a tail risk. And, usually one thinks that in terms of allocating tail risks, actually the government can be better at that than the private sector. So it's not really clear what the value added is at the moment. However, if the GSEs were reprivatized, then the kind of reasons for credit risk transfer that have been proposed in the banking literature start to come into play. So you could imagine that some of that transfer would have benefits if they were reprivatized and they were still too big to fail institutions, and perhaps you'd want to find various mechanisms to reduce their systemic risk, and this would be one of them. My co-author would want me to point out, though, that he thinks that actually these kind of things are a rather poor substitute for capital requirements. Capital requirements provide a general cushion, whereas this credit risk transfer is fairly specific. Okay, so I think I've already been giving the drawbacks rather than the advantages, but just to really talk about the drawbacks, as I'll give you some information about them, they appear to be quite opaque and illiquid. They're very complicated, hard to price. There are limited numbers of investors. When you see who's investing them, the numbers are small. And one of the things we try to do is to take these very highly structured securities and see if we can't aggregate up the information and learn something new, but that's rather hard to do for reasons I'll tell you about. The issuance costs, they say what they are, they're expensive. There's actually, we look at the amount of risk that's transferred and conclude that they transfer less risk than they say they do, which is kind of an interesting mystery that comes up with this analysis. And then my last reason for as a drawback is the one that I really put the most weight on, which is that market participants just love them, which means that from the taxpayer or government perspective, not clear that they should be loving them. Okay, so you probably don't know what they are, and they're pretty complicated. So let me spend a minute describing the structure. So what we have is, so let's take the example of stackers, which is the name of this type of security when it's issued by Freddie Mac. There's a reference pool of mortgages. It could be several $1 billion of mortgages, newly issued mortgages, just like what they would sell in an MBS. In fact, these mortgages will be sold into an MBS. These structures are not financing the mortgages. They're just a mechanism for transferring credit risk. So the reference pool of mortgages is going to have some default experience over the life of those mortgages. And these stacker securities are issued to investors in a way that resembles a credit default swap or catastrophe insurance. So as the mortgages start experiencing losses, those losses are absorbed by the securities at the bottom of the stack that I'm showing. Sorry, let me do this. Okay, so the gray boxes are actually the retained tranches by Freddie Mac. And so Freddie Mac puts itself in a first loss position typically, and then the next set of losses is taken by these B securities, then going up and so forth. So that's absorbed by a write down of principal. And then at the very top of the stack too, Freddie takes the real tail risk in this A tranche. So as I said, the money that is paid in isn't really invested in the mortgages, rather it's invested in risk-free LIBOR assets. So this is all just a mechanism to absorb the risk. I also should mention that something that makes it complicated to understand what's going on with these securities, aside from this tranching of credit risk, is that, you know, the mortgages are prepaying over time. And so as the mortgages are prepaying, there's a release of this principal that makes the life of each of these tranches uncertain. The principal is repaid in the opposite directions, starting with these M tranches and going down in the other direction. So these first tranches are safe, both because they're subordinated from the credit risk and because they get paid back relatively quickly. So I think that's all I have to say about the structure. So as far as, so this is going to be the running example that I show you. It's the example that's written down in the paper. We've now done a similar analysis for a lot of other issuances, and the results are very similar. So you can see the different classes. The total subordination level is 4.25%, and that's much higher than is a typical kind of loss experience. That's actually much higher than the loss experience during the Great Recession. So I guess what's interesting here is two things. One is you can see the coupons are LIBOR plus something, and that something is the insurance premium. Clearly the ones at the bottom of the stack need the biggest insurance premium, and it's high, 10.75%. You can also see that there's these ratings which treat the ones that are relatively safe, that are going to investors, as being BB, BBB, somewhere in there. And then the riskier subordinated stuff is either B- or not rated. What else I want to say? I think that's all I want to say about this. Oh, in case you're wondering about this M1 and M1H, H means held, meaning retained by Fannie and Freddie. Okay. Okay. So we wanted to try to understand what was going on with this market, and we relied on several data sources. One was just the offering documents and financial statements from the GSEs. We also were lucky to get access to proprietary data on secondary market prices of these things from a company called Vista Data Services, which tracked some of the more liquid tranches on these CRT securities issued between 2014 and 2020. And this is basically everything, because they didn't get it started right away. It took a while for these things to start. I'm not going to say anything more about the data, except it's not very real. So it's nice that we have the secondary market data, but we don't take it completely seriously because the things are pretty illiquid and they don't trade very frequently, and some of the data is interpolated, some of it is from conversations, but it still gives you a sense of what was going on, and that was interesting. Okay, so the first, so the first set of things I'm going to show you are not really model based. They're based on just something that we're calling default cost, which is just the principal weighted average of those coupons that I showed you on that slide. So it gives you a sense of what it's costing the GSEs to transfer the credit risk initially through these securities. And so the thing to take away from this picture, I guess, is two things. One is that it seems like they're paying about 17 basis points on average, and it's bounced around a bit, but it hasn't moved around so much over the period. The reason there's two lines on some of these graphs, two set of dots, each of these dots is a particular security issuance, but there's that very giant tranche which doesn't have any protection, and how many basis points you think the risk there is worth makes a huge difference to the conclusions you draw, and I just wanted to point that out. I mean, it's one of the reasons why the market price isn't complete, because you don't see a price on the very most senior stuff and you don't see a price on the very most junior stuff. So whatever your assumptions on those two pieces make a bit of difference for what's going on. This is just to point out that because you're paying off those more subordinated tranches, the average coupon is going up over time. Okay, I mentioned that the GSEs are actually claiming that these days they're transferring a very large share of the rest of the risk on 30-year mortgages. They'll say things like, well, we're really transferring 75% or more of the risk. Our calculations based on what I just described suggest that they're actually retaining quite a bit more risk than they say that they're retaining, for what it's worth. Okay. So okay, I guess one of the questions about this mechanism, which has been interesting, is the question of whether they would actually keep using it in a stress event. And the pandemic came along as an interesting test case. So I would say that the pandemic showed two things. One is that the worry that they would stop issuing in a stress event to some extent came to pass. There were quite a few months where they stopped issuing CRT securities, and then Fannie still doesn't issue CRT securities. I mean, if you wanted to create a mechanism whereby they were going to transfer risk, that risk is most salient when things are bad, but this kind of a security, it isn't a commitment to do that. So that's kind of an interesting fact about this market. Okay, so as far as the question of how much new information does this convey to investors, this is a bit of evidence which leads us to say maybe not that much. So if you just look at that default cost, that weighted average coupon that we were looking at issuance versus a double B option adjusted spread index, you can see that the two track each other pretty closely. And we played around with trying to explain what was driving the default cost by adding other sorts of variables, but really the triple B index had the greatest correlation with it. And we concluded from that it seems like the CRT pricing is probably more indicative of what's going on in the high yield market than anything particular that's orthogonal to that's coming out of the housing market. I mean, perhaps it has an effect, but maybe not. Okay. The other question one might have is, well, if the GSEs are trying to get a market price signal by issuing these securities, are they using that signal in order to set their guarantee fees? That would be the natural use. In fact, the guarantee fees is what they're making. So in some ways, the money coming in should be covering that CRT cost they're paying out, but the two are fairly uncorrelated. I think that's because the G fees, to some extent, are a policy variable now because they're under control of the regulator. They're not private companies effectively at the moment. So we're not seeing this kind of a pass through. This is kind of interesting, and this is the first picture I'm showing you, which is looking at the time paths of the secondary market prices. Not surprisingly, they crashed with the pandemic, and they've recovered some, not completely. The B1s are riskier than the Ms. So the M2s are, as you're going to see, are fairly safe. The B1s are actually also fairly safe, but they're in a more subordinated position. I think one of the things that is kind of interesting about how much they crashed is it may be that the pandemic caused people to expect more defaults. The other thing the pandemic did is it actually gave people some forbearance on mortgages. So all of these mortgages had quite a bit of delay. And it turns out that the value of these securities, particularly the more subordinated tranches, actually goes up the more default is delayed, because they don't take a loss for some amount of time, and then they're getting these really high spreads as long as they're outstanding. So if they can actually last long enough, it doesn't matter so much what the ultimate default rate is. So it's this, to us, this also spoke a little bit to illiquidity in the market, along with other things, simply because it looked like these events weren't going to be so bad for them. Okay, This is just information saying that in fact, there aren't very many investors, they don't trade very often, and the transactions costs are very high. So now this turns to a different and maybe more, well, not more serious, but more academic part of the paper, which is to ask the question, well, what are the expected returns on these different tranches and how sensitive are they to default, prepayment, and recovery? And so we're basically going to use a pretty standard stochastic model of default, prepayment, and recovery, and create waterfalls of cash flows from defaults and prepayments, look at the cash flows on the different securities, figure out the distribution of realized yields on those securities, and then we can ask the question, how do those returns look compared to securities with maybe similar distributions of yields and different and similar credit ratings, and do the CRTs appear to be fair or cheap or expensive, or how do they look? So let me just show you the driving process. So my own clock is not working well. That's why I'm kind of hesitating. How many minutes do I have?
9 minutes.
Oh, good. Okay. Okay. So the default, recovery, and prepayment processes are all modeled as being mean reverting, with default and recovery having the possibility of a jump. And these processes were also truncated to fall within kind of plausible ranges. What I want to say about this kind of modeling is I think I'm sure investment banks have done this, but there's no published information that's available to the general public, or no, I don't think other academics that I know of, maybe Brent will say something different, have done this sort of modeling. And it gives you information that really isn't available in the prospectuses, because the prospectus will tell you what will happen for different constant prepayment rates or constant default rates, but they never really think about, well, what's the distribution of the correlations of these different things that are affecting the cash flow. So it's really quite instructive to simulate it out this way. And so just this is just the calibration of those different processes. Staring at these numbers doesn't mean that much in itself. I guess I'll point out that we set the probability of a jump at about 2.5% to represent the idea that there's about 2 events in 100 years that are really big market meltdown kinds of events. And we created a correlation between default and recovery in that case. So recovery fell in half and default rates went up by a factor of 5. So it wasn't a crazy large probability or big jumps. And none of this I would describe as the truth, but it's ways of kind of playing around with what the payoffs are sensitive to. Certainly, well, since there are options, it's certainly sensitive to volatility in the default rate and the recovery rate and the prepayment rate. But also it's quite sensitive to the speed of mean reversion, because, if you have a very bad shock and it sticks around for a long time, that's the only way, as I will tell you right now, you won't see it in the results I show you, but having a really bad event that hangs around for a long time is the only way you could possibly get losses on some of these securities. Right, so I think I've already discussed or given you a sense of this. So, it's a Monte Carlo simulation. You're gonna draw random numbers to figure out the time series for defaults, prepayments, and recoveries. Every period, that data affects the size of the reference pool. So that's going to be adjusted down with defaults and prepayments and scheduled payments. And then we turn to the CRT pools. I should have mentioned before that the prepayment rules on the CRT is not identical to the underlying. So we have a kind of, what the CRT tries to do is make sure that the CRT isn't paid down too quickly, because they want to make sure that they retain a buffer. So there's a little, you don't pay down the CRT unless there's enough CRT relative to the remaining mortgages outstanding. Okay, so anyway, once you have those cash flows, you put them through the CRT waterfall and you can see what happens. And so this is the example for that was reported, I think, in the version of the paper I distributed. As I said, we're going through an exhaustive list of both these Freddie securities, these stackers, and then Fannie has similar securities called Connecticut Avenue securities. And what we're seeing so far, the results look the same. So I put in, highlighted in yellow, the results I wanted you to focus on. And so recall that the M's are relatively safe, the B's are lower down in the structure, but below B2 is B3. So B2 even is not in a first loss position. Anyway, you can see that the average, this is a 2019 issuances, so rates were very low at the time. Here's the thing that left a deep impression on us, I would say, which is no matter what you do to this model, it's almost impossible to make the M2 tranche or the M1 tranche, but the M2 tranche really hard to make it take a loss. So it basically is getting a 5% risk-free rate, at least risk-free if there's uncertainty as to its duration, but it's risk-free in terms of default risk. When you start, even when you get down to the more subordinated B1 tranche, there's very little standard deviation in terms of the realized yield. Now, what you're seeing here is something that's going to look completely unintuitive, and it's unintuitive to us too, which is this B2 tranche looks like it has a lower mean return than the B1. And but notice it has a really high standard deviation. So the standard deviation is almost as big as the mean return. I think our model is not doing a good job of pricing the more subordinated tranches. So we get a lot of variation in some of the issuances we look at. Things are monotonic, as you would expect. In this one, it isn't. It has a lot to do, sadly, with something very institutional, which is the amount of time between when it goes into delinquency and when the recoveries are made. So this B2 tranche is very sensitive to some other assumptions that I don't really want to talk to you about. What do we conclude from all of this? Well, we concluded that certainly the M1, the M2, and the B1 tranches seem to be less risky than their credit ratings would suggest. They seem to be quite good investments. They seem like it might be a good explanation of why investors seem to like them. The liquid tranches are the M2 and the B1, and so you can see that investors might be quite enthusiastic about that. Okay, so we conclude that actually these things look like they're a relatively expensive way for the GSEs to transfer risk, and it is hard to extract the information content on how the market is viewing the cost of conforming mortgage credit risk when you look at these structures. I think a modest policy recommendation is for the GSEs to save a little bit of money by retaining some more of the risk, because these M1 and M2 tranches appear to be so safe, yet they're paying fairly high rates on them. They'd probably be better off to retain more of that portion of the risk because it isn't very risky. So I'll finally conclude by just saying, this is kind of getting back to the broader issue that, you could say, well, it is a mystery in this market, which is why doesn't the market compete away those premiums? I mean, even why don't the price of those securities get bid up? But there's something in the market structure that just seems to limit participation to a relatively small, sophisticated group of players. There are hedge funds, there's large fund managers. For what it's worth, we presented this at a very large conference with a lot of investors, and they agreed with us. And so they think that it is an illiquid and rather nice market if you can get into it. Thank you.
Thank you, Debbie. The discussant is Brent, Ambrose.
All right, so first, let me thank Tim Fu and the organizers for inviting me to participate. It's a pleasure to be with you, and I really enjoyed reading Debbie's paper. If you're interested in the U.S. mortgage market, this is a deep dive into the plumbing of our mortgage system here. And on one side, you could say, well, why would you care? I would say this is actually a great paper because it tells us about market security design and some of the failures that can happen when government entities start trying to create securities. And so from that standpoint, I think it does have value for everybody, not just the people in the United States. So let me start right in. So the focus of the paper is basically they wanted to develop a framework to evaluate these credit risk transfer securities and the information content of them, and then also to look at their cost efficiency or as a risk transfer tool. Now, the key insights or the takeaways that I got out of the paper was that, well, first, that a well-designed CRT could provide valuable risk price signals if it was well-designed. However, the current CRT securities actually seem to be pretty expensive. They're very opaque, and as a result, they're complex and very illiquid. So as a result, when you look at the correlation of their prices with the BB index, it raises some questions about the information content that we're actually getting out of these securities. And then you delve even further and you find that, well, it turns out that the GSEs are probably not using any information coming out of these securities to set G fees or guarantee fees, which are what the borrowers ultimately are part of, having to pay. And as a result, the GSEs also are potentially facing some pretty significant issuance costs for these types of securities. And so it does raise a number of questions. And so one of the things that comes out of reading the paper is, I don't have a lot of critical comments about it, but like a lot of things that I find I enjoyed reading the paper because it created lots of questions for me. So my comments are going to be more in the form of questions and things that I thought about as I was reading the paper that I hope maybe the next iteration could address, or future research from other people might want to think about. All right, so to summarize kind of what the paper is finding, we go back to kind of first principles. We know that mortgages basically contain two sources of risk. You have interest rate risk and default or credit risk. The GSEs have been very effective in transmitting interest rate risk to investors via their pass-through security structure. They've been doing that for many decades now. And then traditionally, the GSEs retain credit risk. Now, the first thing I had started thinking about was, well, why is that? What is so special about credit risk that we would want the GSEs to retain it? Well, part of it comes about because if you're going to try to foreclose on the collateral, there's lots of institutional problems associated with that. And, so you have to manage that process. Now, we could create contracts that would transfer that credit risk. I've written a paper on that, but we find that those contracts can be quite expensive, and so they're not very popular. The GSEs have also used loan underwriting guidelines and also the provision of mortgage insurance to try to mitigate some of this credit risk. But typically what's retained then in the GSEs is systematic risk coming out of the credit risk. And that leads to what's known as tail risk, essentially. Now, if we look over to the fully private market, right, the subprime, private label, or commercial mortgage-backed securities market, it's interesting that the market is using security structure to pass both types of risk on to investors, right? They basically use the senior subordinated structure. So clearly we could, if we wanted to, send off credit risk to private investors through this type of structure. Of course, when we had a financial crisis, the private label market dried up, CMBS market went to zero, and so then you had the GSEs step in to support the housing market in the U.S., which was part of their public policy mandate. So that kind of explains why we have the GSEs. All right, so now how do these CRTs work? So Debbie gave a pretty good illustration of it. Basically, they're unsecured debt obligations of the GSEs. They're basically a bond that's issued by the GSEs. The return, though, is tied to the performance of an underlying reference pool of mortgages. So they basically think of it as the GSEs have several $billion, trillion worth of 30-year fixed rate mortgages. They tie the performance of the CRTs to that pool of mortgages so that if the mortgages start paying off, then the balance on the CRTs gets written down. And then losses, if there are defaults on the mortgages, they occur bottom up. And so essentially, though, the CRTs now are exposed to both credit loss and interest rate or prepayment risk. So you have both risk hitting these securities. What's another interesting fact, I found this figure from an investment webpage, Brandywine Global, which is demonstrating two types of stacker securities coming out of Freddie Mac from 2016 and 2017. And what I'd highlight here is just look at how much has changed between 1 year in terms of the top level of risk retention by Fannie Mae, or sorry, Freddie Mac. So the AH is being held by Freddie Mac, and then the bottom slice, the B2, is also being held by Freddie Mac down at the bottom. And so you can see that these structures, the securities are changing their dynamic over time as the market is evolving. All right, so now to summarize, what does this paper do? Well, they systematically examine this question of whether or not these CRTs are expensive. They go out, they collect the default cost on the data from the GSEs. They find that the default costs are correlated with the BB index. G fees are weakly correlated, and the GSEs still retain a very large percentage of the default cost, which is quite actually very, very interesting. And then they have some reports on secondary market trading activity to find some significant issuance cost, and that reflects very low trading volume. And I'll get to that in just a second. And then they create a CRT valuation model at the back end of the paper to try to project these returns. And they show that the top tranches have essentially no default risk at all, but have high yields, which maybe want to go out and buy some of these things if I could find them. And it suggests that there's basically some structural inefficiency in the CRT design as we're seeing it. All right, so my comments then. I basically have 3 comments about the valuation model. The first, the model is generating the expected yield compared to the risk-free rate, which is fine. And basically that gives you a risk premium, and that risk premium then is made up of 3 component parts. You have credit risk, liquidity risk, and term risk. So it's all kind of meshed together. And so this is where my questions start coming up as I was reading the paper. So I was thinking, well, is it possible to separate these risks? How much of the premium is actually due to liquidity? I kept coming back to that thought. Why are these things so illiquid, and why? The next part of the model looks at stochastic processes. They have 3 stochastic processes that drive the model for default, recovery, and prepayment. Default and recovery are obviously correlated together. But one of the things that was a little troubling to me was that the prepayment rate, which is the interest rate risk, was not correlated with default and recovery. We know that there is competing risk nature of embedded in mortgage default and prepayment. And so I would suggest that it may be worthwhile considering introducing some correlation between interest rate and defaults via the prepayment model. And then my third comment is I'd like to see some more detail on the model. And actually, this is maybe suggestions for future refinements of the model. So for example, what about calibrating the model to the specific reference pools? because each security is being priced differently. So instead of just pricing a generic default recovery prepayment, can we calibrate to the type of mortgages in the reference? Can we calculate the risk premiums for non-standard mortgages, which is actually the greatest risk the GSEs face? And I'll get back to this point in a second, but remember the GSEs are basically using reference pools of the least risky mortgages. And then finally, in terms of just basic modeling, it may be worthwhile to consider some advanced simulation techniques, such as a weighted Monte Carlo estimators. Gleiserman and you have an operations research paper that talks about that in terms of finance for pricing securities, and that might actually provide some additional insights. Now, so in terms of questions and comments for thinking about this for future research, another comment or question I had was, well, how do these stacker or the CRT securities, how do they stack up and compare against the other insurance contracts that the GSEs are issuing? And they issue this other thing called an agency credit insurance structure. And these two things are interacting with each other, and they're laying off credit risk through an insurance contract or through a security. And so I started wondering about that and started thinking about, well, what is the information asymmetry or the counterparty risk that's involved in these insurance contracts? And can that explain some of the pricing discrepancy that we're observing in the credit transfer risk? I don't know, but it's just a thought to maybe worth thinking about. Again, I kept coming back to, well, why can't markets price this risk effectively? And then I started thinking about, well, maybe they are. It's just that investors don't want to pay for the risk that's out there, and so that's why the liquidity is so low in these securities. And then if you actually think about the most senior rated security is BBB, everything else is below that. That effectively cuts out all the institutional investors from the lower rated securities. So you're basically left with the hedge funds that are buying these things, and so it becomes a very illiquid security very, very quickly. Why do they trade so infrequently? Again, this is part of that liquidity, and I was curious, is this a part of a design flaw in the security? Honestly, I honestly don't know, but it's fascinating that they do trade so infrequently, and what's happening there? And then finally, what are the implications for these securities for the total risk exposure to the GSEs? And again, this goes back to my point that I was making earlier, that it's the easiest price mortgages that are actually being put into the reference pools. All the high risk stuff is not included. So in fact, the GSE risk is much larger than what they're alluding to, because they're not laying off as much risk as they claim they are, given that they've got very safe mortgages. These are 30-year fixed rate mortgages that have very strict underwriting standards, particularly today, and there's very little risk in those security in those mortgages. It's the other stuff that's the really risky stuff that's not being offloaded onto the CRT model. Finally, there's some questions about endogeneity during the pandemic. As I was reading that section, I started thinking about it, going, well, all right, so did the spreads widen because Fannie Freddie stopped issuing these securities? That would be essentially a market signal. Or did Fannie Freddie stop issuing the securities because the market pulled back? That is, the spreads widened as a result of some kind of reevaluation of the risk embedded in the securities. And I think it'd be interesting to try to tease that out a little bit more. And then final comment, what are the effects of the CRTs on the GSE's incentives to minimize losses given default? So remember, who holds the credit risk? Why do we have the GSEs holding it? Well, somebody has to foreclose on the mortgages that go into default. And by having the GSEs hold that position, they're in effect trying to minimize losses. If we have a security or a structure that allows the GSEs to offload all the credit risk, then who's ultimately going to be out there trying to minimize losses through the modification foreclosure process? And so that's something that we should think about as well as we contemplate putting these securities in place. So just to summarize, I think it's a really interesting study. It's obviously a very important issue, particularly for the US market in terms of how our mortgage market works. I think this model that they've developed is very fascinating, and Debbie's right. This Monte Carlo simulation is the way to go for pricing these very complicated, opaque securities, and I think more people should be adopting that type of structure. And it does raise some very interesting questions for the GSEs about how they manage credit risk, and this is particularly important in terms of policy debate today as we contemplate trying to get them out of this conservatorship and potentially privatize them in the future. I'm not going to hold my breath on that because I've been waiting for decades now for them to be privatized, and they're still in the hands of the government. So I don't think that's on the horizon anytime soon, but we can talk about that later. I've been championing that for quite a number of years now. But anyway, thank you,
Brent. Thank you, Brent. So I think there's actually, even though Debbie apologized for not having any climate connection, there actually is an interesting connection between the CRT pricing and the climate. There's actually a paper by Matt Kahn and Amin Ouazada that's forthcoming in the RFS, where they show that the loans that go into these CRT bonds are disproportionately from lower climate risk areas, which is kind of another interesting twist on kind of these CRT bonds and kind of how much risk the GSEs are ultimately retaining versus passing through. So I had a question for Debbie about kind of this question of pass-through, right? Like, I mean, I would argue that the optimal pass-through rate is probably not 100%, right? So even though we would like to get a clear market signal, a price signal, probably the social planner wouldn't want like 100% pass-through from a perfect CRT bond price to the G fee. So that's kind of one quick question. And then on the second question I had is about the episode in March. One interpretation, I think, of this kind of radical decline in the prices of the CRT bonds in March is just the expectation of severe losses. You know, I think this policy response in terms of forbearance arguably only came in later and is arguably responsible for some of that recovery, combined with this fact that you pointed out that it takes a while sometimes for these losses to be realized, and by that point the CRT bond may no longer be outstanding. But arguably that suggested that the market actually did work. You know, if it had not been for the forbearance, maybe the losses would have actually been borne by the CRT bondholders. So just be curious to hear your thoughts on that.
Okay, well, first, thanks, Brent, for a great discussion. I think we need to have a phone call to just geek out on all of these questions, and then and I have to find that climate paper. That's interesting. I agree with you that Mrs. Stin, I agree with you that you wouldn't want a one-to-one pass through between this pricing and G fees. I mean, it would be politically impossible even if you did want it, but you might think that there would be a smoothing of G fees to create predictability for borrowers, but you would at least, I mean, the question is, you know, why create price information if you're not going to pass it through ultimately, even in
Absolutely.
a smooth form, to borrowers? Because what you're hoping with price signals generally is you would want mortgages to become more expensive when the market was overheating, you know, when their credit risk was building, and this is obviously not creating that mechanism while they're in conservatorship. So I know I wasn't expecting a one-to-one pass through. Yeah, and I think, can I just turn to, you might want me to focus more on other things, but I want to kind of turn to the question of optimal security design. I just want to throw out there for people that that's really what we've thought about a lot, is actually if you did want to do these things and make them more informative, more liquid, exactly how would you do it? I think, you know, there was a question came up of would they have the incentive to even keep on collecting on defaulted mortgages if they didn't hold some of the risk? But that isn't a problem because you could always give them a slice through the whole structure, whatever you thought the structure was to clear. Incentives, okay, but it seems very hard to design a security doesn't suffer from a lot of the complexity problems that we've been talking about. It's my intuition that if you just tranched a lot less, you'd be a good way there to simplicity. I mean, if you had what you described, which is more like the PLS securities, where you just had, basically a big subordinated tranche where there wasn't a lot of structuring there, it would be cleaner. Both of you, I think, brought up interest rate risk and how it interacts, and I guess we should put it into the model. I'm going to defend the fact that even though the competing hazard idea is really popular in the mortgage literature, I've found in other work that it has almost no empirical bite. So the competing hazard of default and prepayment is, at least in the models I've calibrated, so Brent, maybe you had different findings, it made almost no difference to include it. And actually, if you look at the original paper, it didn't make a big difference in that paper either. So I don't think that's really the issue. But prepayment, so let me tell you, some of the complexity of designing a better security has to do with prepayment kind of always being there. So I think what we've been talking about is how do you create a security that's useful, that's only credit sensitive and isn't prepayment sensitive, yet prepayment does have a big effect on the dynamics of the size of the pool of risk exposure. So it never goes away completely, even if all you're left with is the credit risk. One last thing is I want to talk about, you mentioned ACIS insurance, the selling to insurance companies. It also, and I think that is an interesting contrast, and I wondered about that. So they've chosen not to do that very much. It seems it's a very small fraction of what they do. But actually, to get around a lot of the issues with selling it to investors who aren't really in the best position to shift through the complexity and everything, I would think they would have gotten better pricing from insurance companies that could look at the risk. They could bear the illiquidity, because that's what insurance companies tend to do. So it's a bit of a mystery to me why they don't rely more on the insurance mechanism. I'll stop there.
Thank you, Debbie.